Thanks for tuning into the Finance News Network. I'm Jessica Amir. Today I'm with MarketGrader CEO and Founder Carlos Diez. Carlos, welcome to the network and welcome to Sydney.
Thank you.
So first up, for those who aren't familiar with MarketGrader, just give us an introduction and tell us about your indices.
MarketGrader is mostly a research company, also an index publishing company. We've been around for almost 20 years. In the early days, we started covering mostly US stocks, and we do that using a quantitative system where we look at fundamental analysis mostly. So our investment view is a GARP, kind of like quality GARP view, and that's how we've always analyzed all stocks. Most recently, we've been covering about 36,000 companies globally, including the entire Chinese market, which is what we're really focused on now.
Thanks for the introduction. Now let's zoom in on China. Tell us about the CNEW Economy Index.
Yes, so we've had for quite a few years a pretty unique forward-looking view on China, where we think that the exposure investors have to China will make a big part of how well they do going forward. So it's the one market where we have a top-down view, where we are very focused on the consumer part of the Chinese economy and also healthcare and tech. So we actually grade all companies in China, but we pick only the best 120 companies from those four sectors, so consumer staples, consumer discretionary, healthcare, and tech.
Now, can you tell us about the performance and the sector exposures?
So all four sectors are weighted equally. We actually have 30 companies per sector. All 30 companies are equally weighted also within the index. So it's an equally weighted portfolio across the four sectors and across 120 companies. It's done pretty well. If you look at the last almost 11 years, going back to the end of 2007, the index is up about 177%, whereas the overall A-share market is down about 30%, so it's done pretty well.
Now, can you tell us about the risk and return characteristics?
So actually, I make a point about that pretty often because investors have not been paid to own volatility in China. It's obviously a very volatile market. It has a standard deviation as a way to look at volatility of about 30% per year. So this index has the same volatility, but unlike traditional passive benchmarks in China, you get paid to own that volatility. So it's returned about 8% annually before dividends, whereas the market has returned a negative 2% annually. So like I said, you get paid to own this volatility. It's a good way to own China.
Carlos, now can you tell us about Chinese companies' reporting requirements and the regulations?
Yes, from a reporting requirements point of view, the Chinese market has come a very long way. Regulators are very focused on Chinese companies being up to par with international financial reporting standards. So, and they're getting close to that point. So we think the companies are reporting pretty good financials. The regulators are pretty strict there as to how companies report their financial statements. So, we're comfortable with that.
Where are they at in terms of valuations?
After the drawdown that Chinese equities have had broadly this year, where they're down about 25%, Chinese equities are trading at historical discounts to their traditional valuations. So in our case, our index, that's the same. It's trading, almost at 50% discount to historical valuation. So it's a very good time to go in and buy Chinese stocks going forward.
So how can investors get their hands on this opportunity?
It's something we're very excited about. Australian investors can buy the VanEck CNEW Economy ETF, which is ticker symbol CNEW. Good way to access China here in Australia.
And just lastly, Carlos, before we let you go, what's your key message that you'd like to leave with investors today?
I think the biggest message is how you own China. So there's two things about that. China accounts already for a third of the world's growth. If you fast forward even 5 years, that's still going to be the case, whereas more advanced economies like Australia, the US, all combined will account for only 15% of GDP growth. So it's important that investors know that and that they own a significant amount of exposure to China. And having said that, it's also important that that exposure is forward-looking and that it's very tied to the Chinese consumer part of the economy as opposed to the traditional manufacturing part of the economy. So that's really what we're focused on.
Wonderful. Carlos Diez, thank you so much for the introduction.
Thank you.